Most people think wealth is a straight line, that if you earn more, save more, and invest consistently, your financial life will naturally expand in proportion to your effort. But the reality is far less linear, because there is a threshold almost nobody talks about, a point where money starts behaving differently, where the same habits that built your first savings no longer produce the same emotional or financial results. And for many people, that threshold sits around $250,000 invested, not because it is magical, but because it exposes the exact place where psychology and mathematics collide. Before that point, progress feels visible because every deposit feels meaningful. If you invest $500 and your portfolio grows by $300, the relationship between action and result feels understandable. You can trace the movement. You can feel ownership over it. But as portfolios grow, something unusual happens. The system begins shifting from contribution-driven growth into capital-driven growth, and most people are not psychologically prepared for that transition. This is what creates the wealth ceiling. It is not a ceiling imposed by income, intelligence, or opportunity. It is a ceiling imposed by human behavior. Most people never break past $250,000 invested because the emotional weight of money changes faster than their financial identity does. At $10,000 invested, volatility feels educational. At $50,000, it feels serious. At $100,000, a 5% decline suddenly means losing $5,000 on paper. And at $250,000, normal market movement can erase more money in a week than many people save in several months. This is where the majority begin interfering with the process. Behavioral economists have studied this for decades, and one pattern repeats constantly. Humans feel losses more intensely than gains. The technical term is loss aversion, but its practical effect is simple. Losing $10,000 hurts far more than gaining $10,000 feels good. That imbalance creates irrational decision-making, especially as the absolute dollar values grow. The mathematics of compounding are simple, but the psychology of compounding is brutal. When your investments are small, you are excited for volatility because lower prices feel like opportunity. But once your portfolio becomes large enough to represent years of labor, sacrifice, and delayed gratification, volatility stops feeling like opportunity and starts feeling like threat. The numbers become too emotionally real. That emotional transition creates the ceiling. It is why many people unconsciously sabotage themselves right before wealth begins accelerating. Some pull out after a correction because they cannot tolerate temporary loss. Some stop contributing because the portfolio feels big enough, even though mathematically it is still in an early phase. Some shift into overly conservative assets too early, sacrificing long-term growth for short-term emotional comfort. And this is not new. Financial history shows the same pattern repeating across generations. During the Great Depression, households that lived through severe market collapses often carried permanent financial caution for decades afterward, even when economic conditions improved. That memory shaped investment behavior across an entire generation. Later, after the dot-com bubble burst, millions became skeptical of equities right before one of the strongest long-term wealth-building periods in modern history. Then, after the global financial crisis, investors repeated the same defensive retreat, often locking themselves out of recovery. The pattern is timeless because the human nervous system has not evolved for long-term compounding. It evolved for immediate survival. And long-term investing often feels like temporary danger. The strange truth about the $250,000 mark is that mathematically, it is still early. If a portfolio compounds at 8% annually, $250,000 becomes $500,000 in roughly 9 years without adding another dollar. Add consistent contributions, and the timeline compresses further. But to reach that next phase, you must survive the psychological resistance that comes with managing larger sums. That resistance often appears in subtle forms. Lifestyle expansion is one of them. As income rises, many people begin redirecting cash flow away from ownership and toward consumption. Better apartments, better cars, more subscriptions, more social spending, all of which feel justified because income increased. But this creates a dangerous illusion. The higher your expenses climb, the less capital remains available to push through the wealth ceiling. And capital is what matters. Income creates possibility, but capital creates momentum. This distinction changes everything. A person earning $70,000 while investing aggressively may break through the ceiling faster than someone earning $150,000 but inflating every part of their life. Because wealth is not determined by earnings alone. It is determined by retained ownership. Ownership is the engine. And most people underestimate how fragile that engine is in its early stages. The first $250,000 often feels slow because your own labor is still doing most of the heavy lifting. You are pushing the machine manually. But beyond that point, the machine begins assisting. Returns become more visible. Time becomes more powerful. The effort-to-growth ratio starts shifting. But the irony is that this is exactly when many stop. Not because the math failed, but because the emotional burden became heavier than expected. So, how do you break the wealth ceiling? First, you must redefine volatility. Instead of seeing fluctuations as judgment, see them as mechanics. Markets move. That movement is not personal, it is structural. Internalizing that reduces emotional reaction. Second, automate distance between decision and emotion. Automated investing removes many behavioral errors because it separates contribution from mood. Consistency matters more than intensity. Third, measure net ownership, not lifestyle status. The market does not care how expensive your car is, how upgraded your apartment looks, or how impressive your spending appears. The only thing compounding recognizes is retained capital. Fourth, understand the transition point. The first $250,000 is often the hardest, not because it requires genius, but because it requires behavioral endurance. It demands staying rational while the numbers become emotionally larger. And that is the real test. Not intelligence, not income, endurance. Because wealth at scale is less about building and more about holding. Holding through uncertainty. Holding through boredom. Holding through doubt. Holding when the system feels slow. Most people never break the wealth ceiling because they think the goal is accumulation, when in reality, the goal is tolerance, the ability to sustain ownership long enough for time to do what labor cannot. That is the hidden shift. At first, money is something you chase. Later, if structured correctly, money becomes something that works. But only after you survive the phase where it feels too important to risk and too slow to trust. That phase is where most people stop. And that is why the wealth ceiling exists. If this changed how you think about wealth, subscribe for more breakdowns on financial psychology and money systems. And comment the word ceiling below if you've ever felt the emotional pressure of growing money. Because understanding where most people stop is often the first step toward understanding how long-term wealth is actually built.